Accumulating the first 100 crore is a task of raw momentum. Preserving 500 crore requires entirely different mechanics, a complex mathematical and structural challenge. We are using the financial affidavit of Thalapathy Vijay as a case study in raw wealth accumulation. These figures place Vijay in the top tier of earners. For the 2024 to 2025 financial year, his declared income exceeds 184 crore rupees. The total gross asset base disclosed approaches the 500 crore mark, split between movable and immovable holdings. In a wealth management context, this balance sheet acts as a living organism. Currently, that organism relies almost exclusively on one concentrated asset, the human brand. A portfolio concentrated around a single business ecosystem and public image remains vulnerable to external shocks. Any disruption to the legacy brand immediately impacts the underlying capital. This balance sheet functions as an active engine. To sustain its current structure, it requires Vijay to continuously generate revenue through his film career. That engine is facing a structural shift as Vijay steps away from film for public office. Assuming the role of chief minister necessitates an active income halt. Commercial film activities must stop. To maintain institutional integrity, the lost film revenue cannot be replaced by new active business ventures. The financial objective shifts from aggressive accumulation to transition architecture. A family office would seek to reorganize these assets to generate cash independently of his political position. Stress testing this affidavit reveals if the current wealth structure can survive a transition into political reality. We begin by analyzing the most liquid bucket, the cash and fixed deposit allocations. These cash reserves are immense. The disclosure shows over 100 crore rupees parked in traditional banking institutions, specifically Indian Overseas Bank, Axis Bank, and HDFC. The reliance on this asset class is heavy. Individual fixed deposits of 25 crore, 40 crore, and 20 crore are listed in the schedule. For an ultra-high net worth portfolio, this creates yield drag. Fixed deposits offer nominal safety, but over a long horizon, they act as a structural liability. These instruments typically fail to outpace inflation. When adjusted for heavy tax inefficiencies, the real purchasing power of this cash actually degrades. This portfolio efficiency matrix shows the trade-off. Fixed deposits provide high liquidity, but their real yield often dips into negative territory. A professional strategy requires carving out a 24-month operational liquidity buffer. This guarantees coverage for personal and political expenses without touching the core capital. The remaining excess cash requires capital rotation. This means shifting out of low-yield deposits and into high-quality, cash-generating equities and bonds. In a high-inflation environment, excessive cash hoarding guarantees a measurable mathematical loss. We now move from liquid cash to the illiquid immovable asset portfolio. This section details a diverse holdings list: agricultural land, commercial blocks, and residential properties. While real estate serves as an inflation hedge, it creates a liquidity bottleneck. Physical assets cannot be converted to cash instantly to meet a sudden political or legal contingency. Furthermore, physical properties require active management, and their valuations are highly subjective based on zoning and market demand. To mitigate political conflicts of interest, a strategic rotation is required. This involves liquidating certain physical properties and moving that capital into commercial REITs for passive dividend income. We also need to evaluate the lifestyle and visibility assets. The disclosure lists a fleet of luxury vehicles, including a BMW 530, a Lexus 350, and a Toyota Velfire. These are consumption assets. Their ongoing insurance, maintenance, and high depreciation rates drain liquidity from the overall structure. Holding this mixture of illiquid and depreciating assets in one individual's name introduces concentration risk. A single shock could compromise the entire structure. An asset base that cannot be mobilized quickly without significant value loss is a liability in disguise. At 51, Vijay is entering a critical governance phase. The primary mandate is no longer growth, it is safe transition. The affidavit's loans and advances section reveals deep financial interconnectivity within the family and through family trusts. Informal financial arrangements are the primary threat to multi-generational wealth. They create ambiguity where there must be precision. This makes a formal succession architecture essential. Properties, shares, and trust interests must be rigorously documented to prevent internal disputes. A central pillar of this architecture is creating a legal separation between ownership rights and management rights. Without rigid legal boundaries, a wealth structure will eventually create internal friction, regardless of the size of the asset base. For a high net worth individual entering executive political office, the priority rapidly shifts away from active management and fully toward institutional separation. This involves transferring all productive assets into a legally binding blind trust. This trust must be managed by a professional, independent family office, entirely removing the family from day-to-day oversight. This architecture of preservation centralizes the wealth. From the settler, capital flows into a managed blind trust, which feeds into diversified equities, REITs, and precious metals, before finally passing to the next generation. This structure eliminates political conflicts of interest by separating the chief minister from his asset allocations. It also insulates family capital from any shocks within the legacy business ecosystem. Finally, it enforces disciplined, tax-efficient compounding for the benefit of his dependents. The durability of this wealth depends entirely on the resilience of the architecture built to preserve it.